I am very excited to welcome Nick Barisheff to the show. He is the CEO of BMG Group. Welcome, Nick.
Thank you. My pleasure.
Man, so 2022 is off to a really insane start. It seems like gold and silver are drastically outperforming the broader stock market. And it feels similar to what I would imagine the 1970s felt like, with oil spiking, inflation, slow growth, and gold and silver doing well. What is your take on what's going on and kind of an outlook for the year?
Well, I think we're going to be many times worse than the 70s. Uh, I wrote a recent article called The Perfect Storm for Gold because we've got all the ingredients that would make it a raging bull market. And yesterday's action is like a taste of what's to come. Gold was up 47 bucks, silver was up 3%, and the Dow fell 543. So that's kind of the early warning wake up call of what's coming. When you look at gold, we've got a number of factors playing in 22. One, of course, is the Federal Reserve's money printing. Even if the Federal Reserve increases interest rates, the thing with inflation being what it is, you're still going to have negative interest rates after inflation. And if you look back to the 70s, interest rates were rising throughout the entire 70s, but inflation was much higher until it hit like 18% interest rates. Then the thing stopped. So while we have negative real interest rates, we've got a bull market condition for gold. The Fed, we'll see what happens, because when they do the first tranche of raising interest rates, you may have a negative effect on the economy, and then they'll pull back right away and call it a day. But just to get back to average annual interest rates, that's 5%. Okay, just to be long-term averages. Now, there's no chance the Fed can get to 5%. So, and there's going to be a risk if they raise it 0.25% on the first tranche that it doesn't spook the markets big time, and then that'll be the only increase they have. So that's one factor. But we have a much worse factor from inflation from the supply demand of goods and services. So you've got money printing, low interest rates on the one hand, but on the other hand, what you've got is supply chain problems that we didn't have in the 70s. And the supply chain problems are multiple factors, but including COVID, businesses can't hire employees, all that's compounding. And now we've got a trucking problem. Before Canada passed this cross-border vaccine mandate, the US was already short 80,000 truckers already. So this just makes matters worse. And it's not just Canada that gets affected in terms of cross-border, but all the northern cities have to have stuff shipped from California and Florida and everything in terms of the winter supply. So we're getting into a big problem there that's compounding the issue. So we're going to have increases in prices of goods and so on, and a reduction of supply at the same time. And then what all this adds up to is basically stagflation, where you have inflation and declining GDP at the same time. So that's your worst possible set of economic conditions. And that's where gold does the best during stagflations. You've got multiple factors, going, for you. Now, at the same time, as a compounding factor, at some point, is going to be the extreme short positions on the COMEX. The gold price keeps rising. They're all going to have to cover. And just the covering exercise could make the prices go ballistic. So they all fit together, all these conditions and so on. So now, at this point in time, it's critically important for all investors. Doesn't matter whether you're rich or middle class, but you need gold as part of their portfolio. My view is you need at least 10 to 20%, at least. But for the investors that understand it and are aggressive, if you look at the likelihood of a major decline in the stock market, and there's many economists and analysts that look at that, like we're into the same kind of overpriced position as 1929. If investors stay invested, in 1929, they didn't break even till 1964 on a nominal basis, 1984 on an inflation adjusted basis. So what that means is that investors that stay invested in the markets today will probably not live long enough to break even.
Wow.
Yeah. So if you add that up, so the strategy, which is totally contrarian to the philosophy of always staying invested, that philosophy is okay in a bull market. It's not okay when you're standing almost at the edge of the cliff. When you're standing at the edge of the cliff, take your money off the table, okay, and wait for the market to settle down and bottom out. What I always use as an example is that we have a Canadian REIT called the Dundee Dream Office REIT. It's a $12 billion REIT with all the AAA office buildings in Canada. Good tenancy as a real estate, it's good. So in 2008, it declined 84%. The dividend yield at the bottom was 20. It's the only investment you would have needed to make. But you need to be out of the market to wait for the bottom to make that investment. Now, if you're sitting in cash, you're not going to make anything, and the money is losing value all the time. But if you sit in gold during that interim period, it's probably going to make money, by far more. So this is totally contrarian strategy to say, okay, get out now, sit in gold, and wait for the market to correct, and then you buy your favorite stocks at 20 cents on the dollar, and then you'll have great returns. You stay in, you'll never break even in your lifetime.
That is so interesting that it took so long for people to actually break even after buying in at the top of a bubble. Because I guess that's just how it works.
Just look at a long-term Dow chart, you'll see.
Yeah. I mean, chasing charts never works out. It never does, but being contrarian generally does.
If you look at the Nasdaq bubble in 1999, it took 15 years to break even. The Japanese Nikkei tanked in 1989, and it's still nowhere close to breaking even.
Right. Yeah, it takes years and years, and no one gets rich chasing charts. It's so interesting. So just thinking about the possible outcomes, it seems like the market is spooked already, and they haven't even started raising rates. So I don't see where it goes from here except for just a really bad correction. I mean, isn't that kind of what's in the cards? And then what are the Fed's options at that point if the market just decides to correct? Because they're going to have to respond.
Well, then they have to pull back and stop it. But because you look at the other instances where they had low interest rates and it went up a bit and the market tanked and so on. But the problem is the market is so overvalued and so vulnerable that a minuscule rate rise could spook the markets. And then you've got all kinds of geopolitical events. You've got Ukraine and Taiwan, and anything accelerates there. You've got the same thing happening. So it's an extremely dangerous time to stay invested.
Absolutely. And it seems that way. I mean, just as we're speaking, everything is just turning red, even though it pumped a little bit because I think the Chinese central bank lowered their rate and that kind of rippled throughout the economy. But now that's all washed out and things are crashing again. So, okay, so the Federal Reserve, I guess the way you're thinking is the market's going to correct and they're going to say, okay, we're not even going to raise once because I think they want to raise in a few months, but I don't think they can last that long.
Yeah. But it might be that they'll trigger the crash. They might, do a quarter point raise, and then the markets crash, and that's all. The markets are so overvalued; they're just looking for something to trigger the crash, and anybody that analyzes it would come to the same conclusion. It's a very dangerous place to stay invested.
Absolutely.
And the thing that happens, which people don't realize, is some say the smaller companies that would have been having good returns and so on. What happens when you have a broad market crash, the thinly traded stocks tend up tanking twice as much, even if they're good. That's like my example on the Dundee Dream Office REIT. I mean, it's not small; it's $12 billion, but relatively speaking, compared to Amazon or Microsoft, it's very thinly traded, and as a result, the declines are magnified. And one other factor that people have to take into account is the leverage in terms of the margin accounts right now are multiples of 2008. So when you have a crash, the margins get called, which accelerates the crash.
Exactly. So the Federal Reserve realizes this and they're going to do some, damage control as soon as it starts to really dip and crash. Probably to reverse course, they could probably say, okay, we're not going to raise rates. And then what happens after they say that?
Well, it remains to be seen whether, people back off or the selling continues and then they're out of options. Because sometimes when you have this kind of momentum, whether it's upside or downside, then it can't be easily stopped.
Yeah, exactly. Unless they try the same old playbook, which is just print even more money than they ever have and go
Right.
super dovish. And
Yeah, but then inflation rises even more.
Yeah.
So that doesn't solve the problem, because the idea of raising rates is to try and damp down inflation. So they print more money, they'll exasperate the problem.
Yeah, that's the crux of this, is the inflation problem. That's why the Fed is even trying to raise rates. So because of that, because it's all based on the inflation rate, why do you think inflation won't be transitory in terms of the supply chain disruptions being resolved, the oil price eventually coming down? Like, why do you think this is going to stick, the high inflation?
Well, because the thing is, you've got also serious economic problems in China. So the US's biggest trading partners are Canada number one, China number two. And if you affect the supply chains in either direction, then you're making the problem worse. And when you eliminate the supply, then prices tend to go up just from lack of supply. And I don't know when all this COVID hysteria ends and people get back to normal. But in here in Ontario, we've got another lockdown. Most restaurants won't survive this. This is the final blow. And the gyms and a variety of small businesses. So how long does it take for all that recovery to take place? When does a new entrepreneur decide to open a restaurant? Be a while.
I get that. You're right. It's the COVID that's really causing this. And who knows when that will let up? Not for many months, at least, right?
Well, there's some hopeful signs as the UK announced that they're dropping all the COVID stuff. No masks, no mandates, no vaccines, getting back to normal. So we'll see how long that lasts. But it's a step in the right direction for the time being. And the issue is they're starting to admit that all their protocols don't work. So that's a big issue, but people are beginning to realize all of this. But I'm sure they're going to have another variant pop up into the place again, or some other biological problem.
Of course. I mean, that's just how these things work. There's always another variant, and there will always be fear mongering about it, and they're always going to overreact to it, right? In terms of,
it's just like the flu. Essentially, the flu has another variant every year. Always has.
Right. And it's going to be the same situation here. So that is interesting. That will prolong inflation for people that think it's transitory. And the longer all this stuff happens, like you're saying, the more systemic it gets. So I can see why you're saying it'll be probably worse than the 70s, because back then they could at least raise rates, and now they can't without pretty much bankrupting everyone, right?
But you see, in the 70s, it wasn't stagflation. The rest of the economy was, more or less okay. And the inflation kept going up, and they kept bringing the rates up till it kind of broke the economy in 1981. So that's a big difference over today. We're starting in a much worse set of conditions than the 70s. When Volcker raised interest rates to 18% to stop everything, can't possibly do that today. Couldn't even get to 5.
Right. It would be a bad depression, and all the baby boomers and their retirement accounts in the 401ks, which everyone's living on right now or trying to in retirement. I mean, What is your outlook for that? Because that's a big problem.
Well, it's a big problem. There's a huge number of pension funds that have, huge unfunded liabilities. And that was before COVID, so a big portion of their portfolios were real estate, and it was commercial and office. And commercial and office are going to be disasters. People aren't going back to work. The downtown office buildings are half empty already. And in the retail plazas have at least 30% vacancy in them already.
So obviously, governments always choose to debase their currency versus having a depression, because they're going to get voted out of office if there's a really severe depression. So they're going to debase the currency. Is there a way that they could they're going to print trillions and trillions and trillions of dollars to try to save that? And that
because when they print the money, they're kind of kicking the can down the road. You're going to have a lag time before you see the increase in inflation.
Right. So how does that look? Because they're obviously, like I said, going to print tens of trillions of dollars to try to get out of this. That will cause bad inflation. obviously gold would do well in that environment.
But you
Um,
see, well, the
yeah,
gold does well, but when you print the money, you're also decreasing the purchasing power of the dollar. So in terms of buying foreign goods, they become even more expensive because the dollar declined.
yeah, absolutely. And I guess they're going to try to prop the stock market up and just sacrifice the dollar in order to do that. And is there a way, do you think, that they can still keep it afloat if they print enough, even though the purchasing power of the dollar goes down?
Well, no, because it becomes a descending spiral. It just a lag time. They will probably do that because by kicking the can down the road, that disaster doesn't happen on their shift. That's all they're concerned about. Some other guys got to deal with it. So that's the least painful solution for them.
Yeah, and that's probably what the outcome will be. And then I guess thinking that the end game here. So if they do sacrifice the dollar and print that much money to try to prop it up, and so what happens to the guy's shift that has to take the blame for it? The final end game, people in power. Like what?
And it takes the final say, well, it's not my fault.
Yeah,
These guys did it to me, and I didn't have any choice.
that's true. That's what they'll say. Well, so what does the market look like at that point if like when the money printing doesn't work anymore? I guess that happened in Japan. They tried it and eventually it just stopped working. Is that what's going to happen?
Yeah, it didn't do anything, and like I say, that I haven't looked at it recently, but I mean, it still was like plus or minus 50% from the highs, and the highs were in 1989. So this is what people don't realize because they haven't lived through it. The implications of this kind of a market collapse, and like I say, you've got such overvalued market by every conventional measure of valuations that put them either at 1999 levels or 1929 levels. Neither one was any good.
Okay, so I guess that's what happens. That's the end game. The money printing stops working, right? And that's kind of what you're saying. Eventually, it'll stop working,
Right.
and there'll just be inflation.
So that's where investors need to stop chasing returns in the market right now and worry about preserving what they have. But by doing that, it's going to put them in position of the greatest opportunity in their lifetime to buy when everything is declined. You'll have great returns if you bought at the bottom.
Yeah, very, very wise. And I agree that buying a REIT and getting 20% yield is, well, unless 20% is lower than inflation.
See, that the interesting thing about the REITs is that the 84% decline was in the price, but the rental income didn't change. All the lawyers, accountants, everybody that were renting office space, all that stayed the same. The two weren't connected in 208. It was just the market declined. That's what gave the opportunity. This time is going to be different. It may be almost the opposite in terms of office buildings. So you have to be very careful what kind of REITs you select.
Yeah, so that's a good question. Do you think residential real estate will still be, robust? Like, will people still have jobs? Will the economy still be humming in terms of, having any sort of GDP at this point in the end game?
Well, at some point, it's going to decline and hit bottom, and then after that, you'll have a recovery. The question is how long and what position you're in at the time. So that's the thing. And in terms of timing, nobody knows that timing could be tomorrow or it could be the fall. But it's not worth for the possibility of a few months more return. It's not worth the risk.
Right. And in the meantime, like you said, it's a perfect storm for gold, and it is a beautifully set up contrarian trade because no one is bullish gold. I mean, very few people, and everyone is long stocks still after all this. So,
and the only reason gold is what you're doing is you're getting out of the market and staying in real money. Like you could go to currency, but the currency is declining. But you're just exiting the market and staying in real money. And real money is only gold and to a lesser extent silver. Both of them will work.
right. Even though in a deflationary crash, they'll go down too, but you're saying they'll outperform.
Well, usually what happens if the market crashes, gold may go down for a very short time, and then it turns around very quickly, and then dramatically outperforms the market. You could have like a 50% decline in the market and a 75% rise in gold.
So, gosh, you covered so much. I think you proved the point about the perfect storm setup for gold. Do you have any potentially closing remarks you want to add? And also, where can people go to learn more and find more updates from you?
Well, for your listeners, we have a book that I published a few years ago called $10,000 an ounce gold. It's available on our site or on Amazon. And there's also an audio CD version of it. So for those that aren't keen on reading, they can listen to the book on the CD. And that takes you through all the basics about gold and money printing in the Federal Reserve and so on. So it's a good place to start. And we have two websites. We have the BMG website, and then we have the BMG DIY site, DIY for do-it-yourself investors. So that site is primarily an informational site with a lot of materials and that to assist investors that are, doing their own investing. So if they go to either site, they'll glean a lot of information there.
This discussion is for informational purposes only. Nothing in this discussion should be taken as investment advice. Guests are not compensated for their appearance. Do not base any investment decisions on the information presented.